Statement of Cash Flows, Chapter 2. Statement of Cash Flows is the third financial statement you need to make yourself familiar with. And it emphasizes critical nature of cash flow to the operations of the firm. It can represent cash or cash equivalents, which are items that can easily be converted to cash within a 90-day period. But before we get more into cash, we're going to talk about the advantage of accrual method versus cash method. Accrual method allows matching of revenues and expenses in the period in which they occur to appropriately measure profits, which can be advantageous when you're presenting that for any kind of investor that's wanting to put money into your. The disadvantage of accrual method, though, is adequate attention not directed to actual cash flow, which is money you have coming in and out of your bank account that the firm has. Cash flow analysis helps us, though, in combating discrepancies faced through the accrual method of accounting and has us to look more diligently at the actual cash position that we're at to know what we have to pay the bills or what we don't have to pay the bills. Here's some of the sections of the statement of cash flow, and there are three main sections. That's cash flow from operating activities, from investing activities, and from financing activities. The result of the three sections are added together to compute the net increase or decrease in cash flow over each period. This chart would be good to reference when possibly doing your homework problems, but cash flows from operating activities to investing activities to financing activities all together will show us our net increase or decrease in cash. As you can see on the left-hand side, there's a cash inflow. And on the right-hand side, there is a cash outflow. And with all those things added together, that will give us what our total cash increase or decrease is. Cash flow from operating activities. It's a translation of income from operations from an accrual to a cash basis. There's the direct method and the indirect method. From accounting courses you may have had before, you would understand what that would imply. That every item on the income statement is adjusted from accrual to cash accounting is the direct method. Indirect is net income is the starting point, and you do adjustments to convert net income to cash flows from operating. This is the net cash flows from operating activities using the indirect method. It's a great chart to reference when possibly doing some homework. This is a comparative balance sheet that we'll use to create a cash flow statement from operating activities on the right. So you can see from there, you take the differences in cash flow from the end of 2009 on the previous slide to end of 2010, and you can create the cash flow sheet based on those different items on the balance sheet. Investing activities are long-term investments, and mainly plant and equipment. The increasing investments represent a use of funds. The decreasing investments represent a. In determining cash flow for financing activities, financial activities apply to the sale and retirement of bonds, common stock, preferred stock, other corporate securities, payment of cash dividends. Sale of firm securities is a source of funds as well, and payment of dividends and repurchase of securities is a use of funds as well. And this shows the cash flow from operating activities to investing activities to financing activities and how they all work together and add together to give the net increase or decrease in cash flows year over year. That is end of Chapter 2, Lecture 3. Please see Chapter 2, Lecture 4 and on course and resources.